Good day, everyone. Welcome to Eleving Group's 12 months 2024 earnings call. We will start with company's presentation, followed by a live Q&A session. We are looking forward to receiving your questions. You can either submit them in writing through the Q&A window or raise your hand and be unmuted after the presentation is over. For your convenience, we are recording this session and replay will be available shortly after the call. That being said, I'm turning the call over to our hosts, Eleving Group CEO Modestas Sudņus and CFO Māris Kreiss.
Thank you, Eva, and good afternoon, everyone. It's my pleasure to welcome you to our earnings call of first 12 months of 2024. So I am Modestas Sudņus, the CEO of Eleving Group. Alongside me, we have our CFO Māris Kreiss, and today together we'll cover our results of last 12 months and with a special focus on last quarter. This is our second earnings call as a public company, so we're sticking to a little bit more extended setup where we, on top of operational and financial highlights, will focus additionally on dividend policy, like what is the expectation for a year. Also, we'll cover stock price movements. And as well, of course, covered like where the company is heading, like what are the main growth factors. But if we look at 2024, overall it was a very memorable year for us, with many highlights, with many goals achieved, and I would say even overachieved in some instances. So that being said, let's jump right away into presentation, into slide number 4, our group performance, where we cover 4 main financial groups KPIs, net portfolio, revenue, EBITDA, and total net profit development. So let's start with net portfolio development. Here you can see that in 2024, we have added slightly more than 50 million new portfolio and ended the year at 371.6 million euros of portfolio, which indicates the growth of 16%. If you look at the segments where it grew, so actually growth is rather equally split between our 3 main segments, flexible lease and subscription products, traditional leasing, vehicle financing products, and consumer lending products. And what's worth to mention, that biggest part of this growth actually came in fourth quarter, around 25 million euros of portfolio were added, and that just demonstrates companies' abilities and growth plans in post-IPO era. If we move over to revenue development, so it grew at a very similar rate by 14.6% to 217 million euros. And here again, it just shows that company is able to grow and not lose its profitability. Also worth to mention that since biggest portfolio growth came in last quarter, revenues have not fully caught up, which will be seen in future quarters. EBITDA followed at a similar rate. We ended the year with 90 million euros of adjusted EBITDA, which was also all-time high for the company. And most important figure is total net profit, where we finished the year at 29.6 million euros. So quite a significant growth compared to the last year when we had 24.5 million euros. And here, I guess additional explanation is needed since the year could have been even better and could stand at 32 million euros. However, in last days of the year, we had to pay Romanian tax authority VAT claim for the periods of 2017 and 2022 for when we were issuing slightly different product, where we were issuing leasing product. And the Romanian tax audit concluded that VAT should have been applicable. So that was done. And then this number, even though it's not related to 2024, it's still booked in this year. So here, worth to mention that we as a company, same as our consultants, we do not agree with that judgment. And then we will be disputing that because according to us and consultants, this is against EU tax law. But nonetheless, even despite that, the overall year has been great, and even 30 million euros marks even stronger percentage-wise total net profit growth while comparing to net portfolio or revenue growth. Moving forward, of course, we can't not mention the biggest event in fourth quarter. So I guess last time when we're covering it, our IPO. So as of November last year, we are a public company listed in Nasdaq Riga and Frankfurt Stock Exchanges, both main listings that marked the biggest ever IPO in Latvian history. And we raised 29 million euros, which we, as promised in short term, utilized very effectively in repaying most expensive liabilities, which were around 10 million of subordinated bonds, as well as selective Mintos loan repayments. So in total, around 21 million euros. And that, of course, allowed us to right away increase company's profitability. But that being said, of course, while we continue growing the portfolio, we tap back into debt markets and again active in Mintos platform. And the plan for us as a company doesn't change. We want to grow the business further, double the business in the next 3 years, as well as maintain attractive dividend yield and having a 50% annual dividend rate to our shareholders. Moving forward, some few more group highlights. Here, let's start with the growth. So our new loan issuances grew by 27% in 2024 compared to 2023. And here, of course, this was the main source for overall portfolio growth. And if you look at the markets, which on absolute numbers have added the most portfolio during the year, so I'd like to call out Romania, Uganda, Albania, and as well as recently acquired sub-Saharan markets. So these markets grew the most in terms of absolute values. Also worth to mention that for quite some time, while acquiring the Lesotho market, we were kind of managing it on frozen stage. But after careful analysis of the market, we decided that even though it's a small market, it has good potential. And already in last quarter of a year, we reestablished more active marketing activities. We reviewed the products, and then we do see that in December, sales picked up. So actually, we now see that this market can become active and should contribute to our next year's growth. When it comes to fundraising, apart from already mentioned IPO, which actually was named by Nasdaq Baltics as the event of the year, we've also were successful in raising debt locally. Just in fourth quarter, we added slightly above 8 million euros in local currencies between Kenya and Botswana markets, which is a great achievement for us. Looking at our highlights, I'd like to mention our green initiatives. So throughout the year, we financed more than 2,000 electric motorcycles, which is well above our initial target. And in this way, we have contributed to the green mobility trends in East Africa region, and then we plan to continue doing so. Now let's move to the next slide, our global scope. Here, to be honest, not many news. We're operating in same 16 markets. Portfolio is again rather diversified and equally split in between the markets. Most markets having 5 to 10% of portfolio share from overall group's portfolio. And if we look at the product split, here again, we maintain similar split. Around 2/3 of portfolio is in vehicle financing, secured financing, and 1/3 of portfolio is in unsecured consumer lending products. So such strategy is something what we kept for quite a long time, and we plan to maintain it going forward to have healthy diversification in between the products and in between the markets. Moving forward to non-financial KPI slide. This slide explains very well where does Eleving Group's growth coming from. So if we start from applications received between both our product categories in the last 12 months. During last year, we have received more than 1,800,000 of applications, which marks a very, very significant growth for each segment. So applications received on vehicle finance side grew by slightly above 80%, so really astonishing result. And then similar trends have been observed in consumer finance side, where we grew close to 50%. There are multiple reasons and sources for this growth, but if I would need to call out the most major one, so on vehicle finance side, it was actually our digitalization strategy, working with new digital sales channels, improving our sales portals and then similar activities. While on the consumer finance side, it was almost opposite. We have strengthened our offline presence, opened new branches, unlocked new populations. So as a combined, the growth was really significant and allowed us to be selective when it comes to our customers. And that can be seen in conversion rates, which for both product lines have went down rather significantly during the year. Of course, that contributed to overall increase in portfolio quality, which we'll cover slightly later. But having 8.3% conversion rate for the year on vehicle finance side and 33.8% on consumer finance side brings us to a spot where we already feel that there's probably a potential to slightly improve these ratios going forward without sacrificing portfolio quality. So that will be one of our focus for the year, just to tailor the products better and then focus on slightly maintaining same level or slightly increasing the conversion rates. With that, handing over to you, Marius, to cover financial highlights.
Thank you, Modestas, and hello everyone on the call. So let's start with the financial highlights first with the slide 9. And if we kick it off with our operational profitability review. So let's look at the EBITDA and adjusted EBITDA figures. Both can be found on the upper left corner of the slide. So we managed to end the year with 92.8 million euros of accounting EBITDA and adjusted EBITDA at a lower figure of 90 million euros. Worth to mention that our adjusted EBITDA is actually lower than the accounting EBITDA, and the adjustment relates to the negative adjustment relates to minority shares of profits. But then there was also a positive add back in relation to already mentioned Romanian VAT expenses that we incurred late 2024. Here, looking at the graphs also of EBITDA development over the years 23 and 22, we can see that we managed to increase EBITDA by approximately 16% to what it was in year 2023. A very similar pattern can be seen also once we look at the net profit and net profit before Forex metrics. So we managed to end the year with 29.6 million euros of net profit and 32.2 million euros of net profit before Forex. And if we compare that to the figures 1 year before, in year 2023, we actually see a 20% improvement if we look at the net profit figure. So that indicates that we are actually exceeding, our profitability exceeds the growth of EBITDA. And that was mainly achieved by our ability to control mainly the borrowing costs. But of course, a substantial contributing factor to this was a successful IPO, which was concluded during the fourth quarter. So that, in a sense, meant that we onboarded essentially interest-free capital, which were able to further optimize our capital stack. If we continue on and look at our equity development, so we started the year 2024 with 82 million euros of total equity and ended the year with more than 108 million euros of total equity. So, of course, the major contributing factor to the equity growth was organic growth, or in other words, profit retention. Then the second source of equity growth was, of course, our IPO. And here you can see 24.5 million euros of net IPO proceeds. So after the fees and transactions made during the stabilization period. With the IPO proceeds, as mentioned before, we already put them into a use by repaying subordinated bonds. Here you can see that we started the year with 16.5 million euros of subordinated bonds. We actually started prepaying them gradually even before the IPO. And then once the IPO was concluded, we repaid the remainder of 12 million euros of subordinated bonds that we had at that point in time. And of course, before the IPO, we already had distributed dividends. This is already an annual event for us. And of course, we have promised to our shareholders also a continuous dividend distribution, on which we'll speak in a later slides. Speaking on the capital, we're to also look at the capitalization ratio as well as equity to total assets ratio. So let's start with the capitalization ratio. So that's equity over net loan portfolio. We managed to end the year with 29.3% of capitalization ratio and 22.7% of equity to total assets ratios. So both ratios are pretty much at the all-time or historically highest levels that the company has ever seen. If we look at the return on equity ratio, here worth to mention that usually companies experience a decrease in return on equity immediately post IPO because of the, let's say, denominator in this equation, because the actual amount of total equity is instantly higher than it was before the IPO. However, in our case, we can be quite proud in our ability to retain the return on equity at the 30% or 31% level, which was already present before the actual IPO. And this is the level that we believe we'll be able to sustain going forward as well. And finishing off with cost-income ratio, here we can see that the cost-to-income ratio has slightly increased in year 2024 compared to the prior years. However, the important aspect here is to mention that many of the expenses that contributed to the increase of cost-income ratio were of a non-recurring nature. So things like already previously mentioned VAT expenses that covered in Romania, that covered the periods from 2017 to 2022. So these are one-off expenses, same in relation to IPO. We incurred different marketing, PR, and professional services expenses that we had to also accrue in our P&L. So these expenses are, again, on a non-recurring nature. So we believe that the cost-income ratio will gradually trend to a lower level, more towards the 35% in a mid and longer term. If we move on now to the next slide, here we have our liabilities breakdown. As before, the majority of our funding comes from issued Eurobonds. As of this moment, we have 2 Eurobonds outstanding, 150 million Eurobonds, which are maturing in year 2026, and 50 million Eurobonds, which are maturing in year 2028. Then the second largest source of financing for us remains to be loans attracted through Mintos Marketplace platform for loans. And in addition to that, we are actually gradually diversifying away from these two largest sources of capital by trying to borrow as much as possible at the local subsidiary levels. In many of those instances, we actually push for borrowing in local currencies, and that not only gives a benefit of diversified sources of capital, but also it helps to mitigate our foreign currency exposure. Because once we lend in local currencies in the markets where we operate, we create an open foreign currency position for ourselves, and we can successfully manage that down by borrowing from local creditors in local currencies, and hence we are naturally hedging our position there. Speaking on the bonds, it's worth to look at the 3 financial covenants and their current state as of the end of the last year. So again, it should come as no surprise, they are at the highest levels they have been. So interest coverage ratio of 2.4 times, with net leverage of 3.3 times, and capitalization ratio of close to 30%. So given this, the strengthening credit profile of the company, We are actually, as of this moment, deliberating a potential tap issue of our 50 million euro bond. And we believe that given the stronger company's profile, stronger company's credit profile will be quite successful if and when we choose to come to the market with the offering. So for those interested potential bondholders, we'll have news pretty much during the course of February. Moving to the next slide on the portfolio quality. Here, if we start with the vehicle business segment, you can see that we have 6.1% of non-performing loan portion in the total net loan portfolio. So NPLs for vehicle business segment are loans which are overdue 35 days and more. If we look at the consumer business segment, here we can see that we have 4.3% of NPLs. These are loans that are 90 days and more overdue. If we look at the right-hand side, here you can see the gross NPL development over the last several years, as well as net NPL development. So the gross NPLs would be pre-provision NPLs, and net NPLs would be post-provision NPLs. So both of these ratios for consumer business segment as well as for vehicle business segment have remained at the relatively stable levels throughout the last 4 years. And we have not seen major upticks in any of them. From time to time, we engage in NPL sales activities, and these one-off activities, they tend to bring mainly impact gross NPLs, and in those instances, they tend to go down once the sale is concluded. Moving on to the next slide. So coming back to the single most important event in company's history during the last year. So that's the IPO. So worth mention that our share is currently being traded on 2 stock exchanges, so Nasdaq Baltics in the regulated market and Frankfurt Stock Exchange in the prime market segment. The current share price development has been a bit lower than than was the IPO price. So the average share price over the last 3 to 4 months has been at 1.68 euros, while the IPO was concluded at 1.70 euros. At the same time, we are being covered by 4 analysts, 3 independent analysts from banks, and 1 commissioned research firm. So all of the analysts actually estimate the fair long-term target price of our shares to be quite substantially above the current trading volume, or even above the IPO price as it was. And actually, 3 out of these 4 analysts are estimated our share price to be about 2. If we look at the, say, quote-unquote, fair market price for the company. Our market capitalization is approximately 200 million euros, with total number of shares outstanding being 170 million euros. And if we compare the number of shares outstanding with the total profit of year 2024, we arrive at 25 cents of earnings per share. Comparing that to the average share price, we would arrive at the PE ratio 6.6 times. So from management's perspective, given the quite low, or let's say optimal PE ratio, and the analysts' estimates for share price in longer term, we believe that we have quite a nice upside potential for our share price in a near-term future. But of course, financial performance needs to support that. Speaking of which, it is worth to look at the financial targets that we communicated during the IPO process, especially for year 2024. So here we have singled out 3 financial metrics, so net portfolio revenue and net profit before Forex. So starting with the net portfolio, we have actually managed to exceed the target that we set for ourselves and that we communicated publicly by 2 basis points. So essentially, we ended the year with 372 million euros of net loan portfolio. On the revenue side, we're slightly below the target. However, as already mentioned before, the largest portfolio growth happened during the fourth quarter of last year, and especially also in the month of December. So that means the revenue has not yet picked up, and we believe that revenue still needs to be earned from this newly issued portfolio, and we have all the possibilities to pick up and catch the target also in the revenue, as we have set for ourselves for year 2025. And lastly, on the net profit before Forex, here we are pretty much spot on to our initial estimate, which was 33 million euros for the year of 2024. On dividends, so our dividend policy estimates a dividend payout ratio of at least 50% on annual basis. It is important to mention that we plan to pay dividends 2 times per year. So the next upcoming dividend payout is expected to happen in the month of May of 2025. So that will be essentially 1 month after annual audited statements are concluded and approved by the board of directors. So once that happens, we would be looking at expected total dividend pool of 13 to 16 million euros, which would essentially be total profit divided by 2. Why there's a range? Because let's say still what we are reporting currently, these are unaudited figures. We still need to wait for audited financial statements to be concluded and signed off before we'll be able to communicate a very specific and exact amount of dividends. But even with this range, we'll be looking at expected dividend per share between 11 and 14 cents. And again, this is the dividend that is being paid out now in May. It will cover half of the profits for full last year 2024. And then we have second dividend payout ratio, which is second dividend payout event, which is estimated to be in November of this year, and that will cover first 6 months of year 2025. And there we also estimate to pay out 50% of those profits that are yet to be still earned. This would conclude my part of presentation.
Thank you, Marius. So with that, before turning to the future plans, let's still look back at 2024. And at the beginning of the year of 2024, we have set ourselves as an organization multiple targets, I would say ambitious targets. And here from the status bars, you can see that most of those targets have been accomplished, which is a great view to see. So when it comes to growth, what we already covered, we were right where we wanted to be and grew by 16% our overall net loan portfolio, and as well as made a significant progress in multiple product developments. The smallest achievement here is related to SME financing products, which we actually were exploring actively during 2024. And at the end of the day, we have concluded that we do not plan to launch any new SME financing products in 2025. We paused this product, and the main reason for that we still see enough of opportunities in our existing product ranges and in consumer lending, where we have most of our knowledge, and then we would not have to go through a bit steeper learning curve, which would be with SME financing product. But we do not. We might still come back to this product in the future years. When it comes to capital management, so here we really achieved, and I would say overachieved our initial goals. We managed to raise equity. We managed to raise a lot of local financing, which, as Marius already mentioned, works as natural hedge, as well as secured hedging solutions for most of our markets, which has volatile fixed currencies. And on top of that, we've also exited Belarus market at the beginning of 2024 and have no ties anymore with this country. Looking at governance and social impact side, big focus for the year was on corporate governance. We published our dividend policy. We established our supervisory board. And probably in this segment, we slightly were behind in our environmental initiatives, but nonetheless, we've accomplished some goals. I already mentioned the electric motorcycle financing goals, and on the other goals, I'm pretty sure we're going to catch up in upcoming months. So now let's look what are the plans for your company looking at the next 12 months. Here we've split everything in sections. So if we start with products and markets, here we look at per hub, per region. So starting with vehicle finance Europe, here strategy doesn't change much. We plan to focus on existing products, existing databases in existing markets, tailoring our products even better to our customers, improving our upsell capabilities and similar initiatives. That being said, we're also almost finishing our market research phase, and we plan to launch one new market in European region. Which one at this moment we will not disclose, but those news will follow in upcoming months. Similar trends and plans are in the vehicle part in Africa and Asia. Here again, apart from focusing on existing products, we also plan to launch a new product, a new secured financing product on which we're already working and implementing. And again, more news will follow already in the first quarter of the year. And secondly, similar to African region, to European region, in African region, we plan to add new market. We're also in final stages of our market analysis, analyzing multiple markets at the same time. And first or second quarter will be the time when we make a decision and also communicate publicly. And lastly, when it comes to consumer financing segment, so there we do not plan to launch new markets in 2025. We rather focus on tailoring our products in existing markets. And at the same time, we still have a lot of potential to grow in the South African region because there we're very, very far away from being at a mature market stage. So there's a lot of growth opportunities. And the already mentioned Lesotho relaunch will add to overall strategy in this segment. When it comes to capital management, the main focus will be on debt capital management. What Marius already mentioned, we will explore in very near future potential to tap some of our existing bond instruments. And at the same time, we are being aware of our biggest 150 million euro bond maturity at the end of 2026, where we want to address that ahead of time and already this year have a solid plan in place with maybe even an execution. So more news on that will come later. And of course, all that we still want to accomplish while maintaining a 50% dividend payout ratio, which with our levels of profitability is doable. And as Marius mentioned, the upcoming dividend will be in May. It will be like a special one because it will be for the full 2024. And afterwards, we're moving to semi-annual dividend payment frequency. And lastly, we're actively working on our ESG strategy on next 5-year cycle. And during 2025, we're going to present it and then publish it. So with that, I'm stopping here. Now turning back to the operator for your questions. Thank you.
Thank you for the explicit presentation. We're now opening the floor for questions. Please submit them in writing through the Q&A window or raise your hand to be unmuted. We will start with the questions submitted prior to the call, then prioritize the audio questions and continue with those submitted in writing. We have received several questions about dividends. As this topic has already been discussed during the presentation, we will continue with other questions. However, if anything has left unanswered, please submit your question through the available means. The second question, in which market do you feel the weakest or most uncertainty?
Thank you for the question. So here I would not maybe want to call some specific market, but overall we of course acknowledge that we are working in multiple developing markets. we have in total 16 markets, so every market lives its own life, and there's many events happening every single month in certain markets. I know we could call out market as Georgia, which had a lot of riots in recent months. However, we see that due to that, our business has not been affected. We're also going to have some other, let's say, more economic political events in certain markets. There's going to be elections in African region. However, we believe that we already are used to these, let's say, events which are not necessarily dependent on us, and we're able to adjust to those events successfully. And on top of that, operationally, I would like to say that in none of the 16 markets now we have significant issues. We have good understanding of the product mix which we're offering and of the opportunities that those markets present. So overall, we do not see that one particular market is somehow especially problematic, or that we would consider, I know, to exit it or some other activities.
Thank you. What are the strategic choices the Eleving Group management is facing today?
So strategic choices are a lot related with the development. I believe as a company, we've put ourselves in a very good position for growth in recent years, and we have capital for that. We have different available debt sources, and here it's very important to do the growth in the right way, to find the right mix of products to make sure that our teams are focusing on the best opportunities available in the market. So this is something what's being discussed among different management layers daily, and to have a controlled but at the same time still significant growth. That's a challenge, but that's at the same time opportunity, and then something what drives us further.
Thank you. We'll now be taking the audio questions. Marius, please.
Yeah, hi. Thanks for taking my questions. I have two of them. The first one would be on refinancing. If you would have to refinance today, how would the terms compare to your current refinancing vehicles? And the second question, we just had the slide here with your business outlook for 2025, which is more on the qualitative side. This is still translate to portfolio volume growth of around 20% in 2025 and a respective revenue growth, or what should we expect there?
Okay, thank you for your question. I'll start with answering the first one. So on the refinance, if we would do it right now, we believe that if we would come to the market today or in a very near future, the refinance terms would not be, as a minimum, would not be worse as they have been with the previously issued bonds. Actually, worth to mention that where our currently 2-year bonds are trading. So the largest 150 million euro bond, which provides 9.5% coupon, is trading at or very, very close to par. And the other euro bond, which has 13% coupon, is trading with a premium, which is around 110 euros, 110%. So, and that would translate into a yield which is close to or even slightly below 10%. So both of our bonds, where they are trading now in the secondary market, they indicate that the cost of debt for us as a company is at or around 10% annually. As it relates to the actual structure, we believe that both euro bonds have a very good structure already in place, which is a senior secured structure with guarantors and pledgers. And we believe we'll be able to continue that structure also going forward once we issue new debt or refinance existing one.
Okay, and answering the second question, so maybe I'll start with a reminder that in our webpage investor section, you can find our growth plans for 2025 and 2026. And The question was like whether portfolio growth is projected to be around 20%, and whether the revenue will follow. So the answer is yes. Like revenue growth is also projected to be at around 20%, and profitability actually is projected to be even higher than 20% because we do see that there's still potential to tap into economies of scale.
Thank you. We have our second audio question from Fawad. Please go ahead.
Yes. Hello. Question on refinancing again. You mentioned a 50 million tap on the 28th. Can you please tell us what will be the use of proceeds? And on the 2026, will you roll out the entire amount of debt, or are you planning to pay down a bit of it? That's it. Thank you.
Thank you for the question or questions. So on the first on the potential tap of 50 million euro bond, the use of proceeds will be mainly for the growth of the loan portfolio, as well as for refinancing some of the existing liabilities that we have in place. And of course, we would start with the most expensive part of it. And in many of those instances, that would mean prepaying in advance some of the loans that we have attracted through Mintos marketplace for loans. And then on the 2026 bond, most likely, since we're on this growth trajectory, and also you can see that, let's say you can see the net loan portfolio, which we anticipate is going to be growing up to 20% per annum for the next 3 years. We would not prepay any of that amount partially or fully. We'll be pretty much looking actually to replace that 150 million euro bond with a potentially even larger bond. So that would be our base case approach, how we would approach this debt refinance activity. Of course, we'll do everything that's possible from management side to also offer any existing bondholder to be able to kind of roll over their existing bonds or investment into a new one. But the actual mechanics of that exercise, they remain to be seen, and most likely there's going to be more information on that during the second part of this year.
Okay, thank you.
Thank you.
Thank you. Let's now continue with the questions submitted in writing. What would your 2025 target loan portfolio growth be, excluding the planned 2 markets?
So I don't recall exact figure, but it would be very close to those 20% because we plan to launch markets, let's say, after first quarter, and typically once you launch a market, we do it very carefully, and then first year it's quite small on growth, so most likely it would be just a couple of percent lower. So something around 17-18%.
Thank you. Minority share in total net profits increased from 18% to 20% year over year. Do you see this limiting the dividend payout of 50% from total net profits, but instead choosing net profits to equity holders of the parent company as a base?
Yeah, so as per our dividend policy, we expect to apply a total profits as a base figure for the dividend payout. So that's the current approach that we take as a company. If there's going to be any changes to that, we'll communicate that appropriately.
Thank you. We have one audio question from Frank, please.
Yes, hi, Modestus and Maris. First of all, congratulations, a busy year behind you, and you have an ambitious plan looking to the future here. I had a few questions which were already asked and answered. Thank you very much, and a good presentation too. Can I go to page 7, please? And I look at the portfolio balance. And Modestus, you said you want to double the business in the next 3-4 years. Now, looking at your markets, it seems some of them are saturated and some of them you have only scratched the surface, like in Africa. Now, we do not want to end up having a completely African operation. I think we discussed that before. But can you point out how this breakdown with these three colors, yellow, blue, and green, traditional financing, consumer, and flexible, how that's going to look like? Is that going to stay like that, or is it going to have more dynamics on the consumer lending? That's what I feel. That would be helpful if you can point that out, how that's going to change. Or maybe you can also just point out a little bit on the regions where you see that doubling potential. Thank you.
Okay, thank you, Frank, for your question. In terms of portfolio mix, so this is, it moves every quarter slightly, but
Sure.
but we see that, yeah, maybe consumer financing will grow slightly faster than vehicle financing, because we are actually launching consumer financing products in some of the markets where we've been working only with vehicle financing products, and mainly focuses on existing customer base, because naturally
Sure.
people do not come to buy a car that often, but at the same time, these are customers which we know, so we're adding them additional products, and that will bring quite substantial growth
Mhm.
here. And biggest part there is in European region, so European vehicle finance
Okay.
region. At the same time, talking about African, I think you concluded also very correctly that potential, we're just looking at the sheer size of population. It is bigger than European part. So Africa will slightly outgrow based on in our projections the European part, but we do not see that it will reach, let's say, next 3 years, 50% or close to that.
Okay.
Most likely it's going to be 40% range. And lastly, while launching new markets, we plan to launch them not only in African region, but at the same time in European region. So they will start playing a more major role in the last year of this 3 years projection period, when we already are confident with underwriting and so on. So a mix of that will bring us close to doubling the portfolio, what we have indicated.
And M&A is not on the agenda, right? I have not heard that in the last number of calls. So buying someone who might be there, or in the past, you have also talked to your shareholders and found some operations that might be applicable to be added to the portfolio.
Yeah, so we're not ruling out M&A as a
Okay.
growth route. We're as a company, we're open to listen to different offers, and then we're often reviewing some. But it's not that easy to find these ideal
Right.
acquisition targets, because this is specific segments where we operate, and we need to find businesses which are valued in a attractive way, and also where our presence could add, could improve unit economics. So we are not disregarding, but that's not our kind of core course for growth.
Now, on the consumer finance side, Modestus, you have basically two different products. You have the senior unsecured lending in Europe, but in Africa, if I understand it right, you do these PDL, the payment deduction loans, right? Where you go to government employees where the repayment of the loan gets deducted at source. Is that something that can grow significantly, or are there limitations to this payment deduction loans? What's your thinking here?
Yeah, exactly correct. That it's two different products, and in all of the markets, it can grow still significantly, because we need to look at the base where we stand. So once we acquired these markets, they were very small, like having up to 10 million euros of
Right.
portfolio. So we've been growing them successfully, and just maintaining same level of issuance what we have, let's say, what we have experienced in last quarter. We see that in some of the markets that portfolios will double on 1 or 2 years. So potential is there. This is, as you mentioned, quite secure product. Also worth to mention that here growth has to come together with a debt instruments, either hedges in those markets or local financing, which so far we've been successful in Botswana and Namibia. In Zambia, it lags behind, but we're working on that. And Lesotho being tied to South Africa, Lesotho currency, we also see that once portfolio becomes sizable, there will not be any issues to either get local financing or ensure that currency is hedged.
Okay. Okay, I understand that. And my only question to Maris, who I usually have much more questions. Maris, the FX side in the past has sometimes been noticeable in your P&L and has usually given you every now and then a hard time and about how you find hedges. Now you have been on a deal making spree where you kind of looked for local sourced FX based foreign FX based funding, and you were successful. So looking at a much stronger dollar today than where it was 12 months ago, what would that typically show up in your P&L? Would that be as a total a positive, a negative? Because it's likely that with Donald Trump, we will see a much stronger dollar coming the next couple of months.
Yeah. Okay. Thanks for the question. So, as a general rule of thumb, so the stronger dollar actually is contributes positively to our bottom line, be it through effects line in the P&L or in the comprehensive income directly through equity.
Okay.
So it's a net positive effect. Because first of all, euro depreciates against the dollar, and then foreign currencies, especially in these frontier/development markets, they tend to follow dollar more than they do with the euro. So yeah, that's kind of the overall trajectory what we see in our P&L.
Thank you very much, and best of luck for Q1 and for 2025. We will speak again.
Thank you very much.
Sounds good. Thank you.
Thank you, Frank. Continuing with the audio questions, let's take one more from Fouad.
Yes, just a follow-up question on local financing. I mean, you've been successful. Are there any limitations? I know it's not that easy, but like, can you continue this trend of financing, more financing from local in the local countries where you operate?
Yeah, and so generally the answer is positive. So we can continue in financing in local countries because the portfolios, especially in these markets, especially in the African region, they're still growing. So we are constantly in the need of new capital. So that kind of provides this positive momentum for us to be able to borrow locally. In addition to that, every subsidiary where we operate is actually improving its bottom line. As of this moment, we have no single loss-making market in our loan portfolio, even in the African market. So that means that we have the ability, willingness, and appetite to onboard more local financing. Of course, the amounts here we're talking about would be not in tens of millions, but the gradual growth of several millions per quarter.
And maybe just to add to that, the hardest is the first step to get first financing facility in each market, and then with time, actually, you build a track record, you build transparent business. It becomes easier to raise additional funds in those markets.
Understood. Thank you.
Our next question is about the subsidiaries. Do the subsidiaries where minority shareholding is the highest contribute most of the growth? Based on the growth in respective markets, could we expect minority share of profits to continue to increase?
So on that, like worth to mention that we do have minority shareholders at different layers, at country level, as well as regional hub layers. And it does fluctuate every year, dependent on the performance of certain markets. But and I think in last year, it's correctly noted that markets with higher minority shareholdings were more successful. But overall, we do not see a trend of increasing that minority shareholding portion would increase. Actually, we do believe that there might be the opposite scenario, that it will be stable or actually even slightly decrease.
Thank you. There is a question, when will there be actualized research reports available?
Apologies for that. So on the research reports, so as mentioned before, 3 out of 4 analysts are bank analysts, so more or less independent analyst teams. And we believe they are actualizing their research papers at least annually. So since the previous research reports were issued during the Q4 last year, probably we should wait for some updates during the second part of this year. Having said that, we know that at least Enlight Research is currently updating their research as of this moment. So there's going to be at least one research paper / report that is going to be actualized already during this quarter.
Thank you. Are there any additional share capital increases under discussion in 2025?
No, there is no such discussions at this moment.
Is Express Credit profitable at this point? If not, then how much it should be scaled to reach desired profitability?
So as a, let's say, region, Consumer Finance Africa, it is profitable, and two biggest markets are Botswana and Namibia, so they are both standalone profitable and growing. Zambia finished last year also with a very, very slight profit, but it still needs scale. And Lesotho is market which is has very low portfolio, but at the same time very low costs, and it is at around break-even level. But as already mentioned, this is a market where scale is really, really needed, and with the scale, real profitability will come. So our expectation that for this year, for 2025, all of these markets will be profitable on a standalone basis.
Thank you. We'll take 2 more questions. Can you please comment on the timeline for 2026 bond? Is it a priority goal to refinance in 2025, or are you willing to let it lapse into 2026?
All right. So the base case scenario would be to have already a tangible plan in place how we will approach the bond refi during the first half of this year. So let's say by end of May, we expect to have already a lead manager onboarded and possibly already sales syndicate formed. So that means that the team would be ready to actually come to the market during the second part of the year already. This would be our base case scenario because we as a company, and we believe also our rating agency and other stakeholders would feel more comfortable if we would have the bond maturity addressed already during this year. However, even if that does not happen, we still have the time window of the first half of year 2026 as a backup option if for some reason, and mainly the reason could be market conditions, we choose to come to the market, let's say 6 months later.
Thank you. Are there any intentions to introduce the check-off loan product in Uganda? If so, could you please explain the reasoning behind this decision, whether affirmative or negative?
Okay, so here I assume that check-off loan is being referred to this deduction at source or these payroll loans. So currently we do not have a plan to introduce in upcoming future a check-off loan in Uganda. And the reasoning why no, because we still see a lot of potential in existing product mix in adding similar secured products, not going into this let's say check-off product. That being said, I'm not saying that that's not a good opportunity, but there's many opportunities in different markets to launch different products. We just need to pick the right mix, and then currently in Uganda there's plenty of opportunities to still grow in existing product setup.
Thank you. And finally, we are asked to clarify whether your target net profit is before or after minorities.
So I guess the question refers to our announced goals. So where we are highlighting net profit before Forex. So that figure includes also minority shares of profit. So basically all inclusive total net loan portfolio, both majority and minority together.
Thank you. All questions are now answered. So we will be closing the call shortly. Before we do that, over to you, Modestas and Maris, for closing remarks.
So just want to say thank you very much for everyone who joined the call. Thanks for interesting, insightful questions. And we wish you a nice day, productive week, and until the next earnings call. Goodbye.